Jeff, we're talking about an article that you posted at Alhambra Investments on the 14th of April, and you said, it's right there in the title, why only that specific one? So this bond is a 2-year bond. Now, it's interesting because the 2-year bond, no, I keep saying bond. It's actually, what is it? It's a note.
Yes,
right?
it's a note.
And it's
those things used to mean something. The difference between bill bonds and notes used to have legal ramifications, and they kind of get confused together nowadays. But yes, well, that's a 2-year note.
Well, that's interesting. If you want, tell us about the legal ramifications. But if not, tell us about, just set the scene. Bills are doing this, bonds are doing that, and here's this note in between. Tell us what the context is.
We've talked about the short end of the curve, the bills. They've been overbid to the point where the front end of the curve is flirting with zero, still flirting with zero. And then all the bills out to 12 months are getting compressed downward, 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 which isn't such a positive signal, especially in the context of Treasury bills, repo collateral, those kinds of things. At the opposite end, into the bonds and the long-term notes, like the 10-year and the 7-year even, those obviously have been selling off, especially January, February, in some way, partway into March. The notes and the long end treasuries have been selling off rather more significantly. In between them, between the long end notes and the bills, is the 2-year note. The 2-year note has kind of been yo-yoing back and forth between sort of the negative non-reflationary picture in the bills and the more resolute or seemingly resolute reflationary trade in the longer term treasuries. And it kind of it's been a pretty volatile mess and mix for the 2 years.
And I've pulled up a graph from your article here where we're looking at the 2-year constant maturity, which I would describe as sort of the theoretical yield should a particular 2-year bond exist on that particular day. And it's interpolated from the 2 years that do exist and other tenors. And what do we see? We see I would say, yeah, like you said, it's percolating, it's fluctuating back and forth. But the one that we're interested in, the one that you have a red arrow to, says record lows. And that date, ladies and gentlemen, if you have been following this show for a little bit of time, will immediately pop up on your radar screen. You will perk up when I tell you that the date of this auction was February 23rd. Tell us what happened just 2 days later, Jeff.
Well, February 23rd, this 2-year auction was showing you was perfectly fine, perfectly normal. In fact, it was well within all parameters that had been established for the 2-year note auction. So February 23rd, 2-year auction, and it was a big one too. It was another 60 some odd billion or 60 billion of 2-year notes that were auctioned, which is at the elevated post 2020 increase in debt.
But Jeff, you say perfectly normal. But then you've got a line here that says record lows for the auction high yield. It wasn't perfectly normal
for that particular case.
They were people that auctioned high yield had never been lower for a 2-year constant maturity bid. No, not
you can
constant
see where
maturity.
the median auction yield is down around 9 basis points, which is about 2 basis points underneath the secondary market pricing. So it wasn't for that period of time and for the last however many years. An auction that goes off in this kind of a fashion, yes, record low yield, but that's typical for typical contained or continued demand for U.S. Treasuries at auctions. That dealers are there, they're bidding, they're overbidding. There's plenty of potential buyers at these things, willing to pay whatever price they have to.
2 days later, Jeff, it was pandemonium. Cats and dogs were living together. The dead were rising from the grave. The U.S. Treasury yields surged, not just the 2-year, but all the way across the board. I've got a few quotes here. Let me read them. Investors haunted by February's grim 7-year auction, which stirred concerns about the health of the Treasury market, are paying keen attention to the upcoming sale of debt. Investors are bracing for a trio of large U.S. government debt auctions this week after a recent sale of 7-year notes flopped and set off about a frantic trading. Quote, investors will remain on pins and needles until the auctions are behind us, said Gennady Goldberg, a rate strategist at TD Securities. Another quote, People can't say that what happened on February 25th won't happen again, said a managing director in the rates division at a large US bank, adding that they were, quote, increasingly concerned. Quote, until investors are comfortable knowing the Fed's tolerance for higher rates, it is unlikely that most Treasury buyers will want to catch a falling knife for higher yields, said Megan Swibber, a rates strategist at Bank of America. And then Kirk Lazarus for Tropic Thunder Securities said, time to man up. I ain't gonna sugarcoat. Some of us might not even make it back, which prompted some traders in the back who were concerned to say, what do you mean? Like not on the same flight? Jeff, there was fear in the markets. It was it. This was the big one, February 25th. What happened?
February 25th, as they all said, 7-year auction flopped. It was lowest bid to cover in its history. Suddenly there was, basically dealer participation was sort of, mediocre. I mean, all sorts of things that outside the normal of what we had come to expect. You see the auction yield pricing way, way, way up above where it had been trading the day before. And it was a total and unbelievable mess. And I think most people remember that day because the entire Treasury curve sold off, particularly the 5-year note, which had an enormously awful day, and maybe don't realize that there was this 7-year note auction that happened during the same day. And it was after the 7-year note auction that the results of the auction had been announced that the Treasury sell-off really started to pick up in its most violent fashion. So the 7-year note auction on the 25th caused, people have been, there's too many treasuries that the Fed is, the Federal Reserve can't tolerate higher interest rates, inflation's coming. All of these things seem to be, at least they seem to fit in these mainstream narratives that the Treasury market was toast. And here we have finally, for the first time, perhaps ever, a actual auction that went so poorly that people could point to and say, look, we've been telling you that there was a danger of too many treasuries and too much inflation for a long time. Here it is. Finally, we've got the busted auction.
And after that, every auction after that went off terribly. Isn't that right, Jeff? And it's been proven since then that indeed the US government has lost its moorings. It's time to be punished. The bond vigilantes are here. Isn't that what happened?
Yeah, inflation's out of control, all this other stuff. No, and that's the curious thing about all this is that every single auction since then has been right back to where we were before. You go to the 10-year, the 5-year, the 2-year, whatever maturity you want to look at. Even the 7-year auction that was conducted in late March. And there's another coming up in another week. 10-year note auctions. There was a 10-year note auction before and after this February 25th event. They went off fine. There was a 10-year auction earlier this week that was right on the screws. I mean, so no, none of those things were true. The market could not have taken its inflation fears and put them into the Treasury auction process. It could not have said there's too many treasuries. We're now becoming it's now a buyer's strike of vigilantes, as you said, Emil. It was only that particular auction that went so poorly. Just that one, just that 7-year note. And the 7-year note didn't really matter. It just happened to be the one that auctioned on that day. And so what we're focusing on is why February 25th? It may not have mattered what instrument the Treasury sold that day. That was the day it went bad. It's every day before, every day since, it's been the same. Treasury auctions go off fine. Plenty of dealers, plenty of bidders, plenty of all the things that we associate with, high demand for safe and liquid assets, except for February 25th.
Jeff, I have one of these new technologies. It's called a calendar, and I believe you do have one as well. And I'm looking at this calendar, and you know what I've noticed? That between February 23rd and February 25th is something called February 24th. And for the audience that has been there for episode 49.2, 46.1, and 52.1, you know where we're going because we've been talking about it for a long time. Jeff, February 24th, what happened? And more importantly, was it something huge, or does it speak to another, just the general weakness that any little spark will halt this progress towards recovery?
Yeah, February 24th in the afternoon, the Federal Reserve announced that FedWire had been interrupted for an operational or clerical error, whatever they're calling it nowadays. It's never really been explained. And
Yeah,
honestly, the way
it
you frame
hasn't.
the question is actually true, is that it shouldn't have been anything we would, other than a minor curiosity, quickly forgotten. And the only reason we're even still talking about it is not only that it connects February 24th to February 25th, but more importantly, it seems like it is the inflection point that shows up on every single chart around the world. We look at February 24th, 25th, 26th, you see Japanese government bond yields, for example, which were highly reflationary, the same as in the United States and US Treasury. Why would they stop being reflationary on February 26th? German federal securities, Bunds and Schatzes and Bobels and all those, weird named things, same exact thing. They were highly reflationary, like Japan, like Treasuries. Then they stopped. All of a sudden, the reflation trade stops. Why would a busted 7-year auction, which is supposed to be the market saying inflation's coming, it's all coming too much? Why would reflation embedded in causing that 7-year auction to go so badly end reflation everywhere else around the world? And not just everywhere else around the world, but as we've seen before, in the TIPS market, real yields peaked February 25th as well, which is a reflation. They were reflationary and rising. So why would reflation busting an auction on February 25th end reflation in every other corner of the world? And it gets back to the question, why was February 25th auction so, monumental that it shows up in all of these different places? And the only thing we can connect it to is the day before this FedWire disruption, which really shouldn't have been a big issue. But then you start to think about, what does the FedWire disruption actually mean? It's not a disruption in FedWire so much as it is a disruption in the monetary plumbing, which would absolutely affect dealers. The same dealers who, by the way, were conspicuously absent on February 25th in the way that they had been acted dependably beforehand. So if the FedWire system tripped up and caused the dealers to step out of the February 25th auction, which seems to be the case, then that's a signal of fragility, that just like September 2019 repo, when something unanticipated goes wrong, dealers cut back when they're supposed to do the opposite. We need them to step in when things are going poorly. So in the terms of February 25th, what should have happened under a robust system is absolutely nothing. The auction should have gone off exactly the way they had before, exactly the way they have since. There would have been no huge sell-off in the Treasury market, which is another sign of illiquidity. And what that seems to have transmitted to the rest of the global marketplace is, we may have a problem here. As much as things seem to be going right, the system's flooded with bank reserves and inflationary excesses, government fiscal spending, all these positive liquidity aspects. Allegedly, we have an example of a very tiny thing becoming much more than that, because the system may not be as robust and as resilient as otherwise it's been said.
The image that for some reason jumped into my mind is of the dog from Call of the Wild, Jack London's story. At the beginning of the story, he's being abused, that dog. He's being beaten over the nose with a newspaper constantly. He's been trained to be afraid, and that's what we see with the dealers. It's been 14 years of the Eurodollar system and the central bank incompetence and the political lack of leadership. They've gotten used to any sort of little wobble, they just stand back. And this was just the latest incident. Jeff,
it was in the Treasury market. It was a Treasury auction, the big violent Treasury. And so it wasn't the fact that yields rose as a consequence of the Treasury sell-off. It wasn't a reflationary increase in interest rates that the market took from this. What the market saw was illiquidity. That even Treasuries had sold off so badly because there was so little liquidity in the Treasury market. What does that suggest about everywhere else? It suggests that risks are material and materially greater than we're led to believe they are. So it's not so much that February 24th and FedWire matters so much. That's not really the issue.
Symbolic.
Here. Right. It's just a tiny little thing that led to a bigger thing. And really, again, chaos theory, Mandelbrot, all that stuff. When you see something small become something large, especially in very short fashion, it's a sign of fragility. And fragility, not just in a naked general term, but fragility in the sense of a complex system that is not robust. And that's really, I think, what the global marketplace has said is, whoa, hang on here. Everything was supposed to be going right. Now you have this little nothing happen lead to this massive liquidity problem. I got to start rethinking my whole reflation idea here, because along with other things, maybe things are not going as well as we're led to believe they are.
I would love to do a show with you and Keith McCullough talking just about Mandelbrot, complex systems. That would be a fantastic show, I think.
Multifractal geometry.
Yeah, that would be a great show. Maybe we can do it. Jeff, I had a wonderful time, as always, on this episode. I hope the audience learned and found some parts of it entertaining. Thank you, Jeff, and I'll talk to you again.
One last before we go, what's the name of our droid? We now have a name for a droid.
91282 CBN0.
CBNO. So CBNO. That's our Eurodollar University droid. CBNO from here on.
I believe that it will be available shortly at eurodollarenterprises.com. They are, of course, our sponsor. They're the people that look after that disaffected part of our society that has been long overlooked. The monetary technocrat, the academic economist. And we're very proud to be sponsored by them. Eurodollar Enterprises, get your own CBNO droid soon. But first, this from Eurodollar Enterprises. Friends, are you worried your monetary policies are causing lurid levels of inequality? Are you concerned civil war, its hour come round at last, slouches toward K Street? Do you worry how your supple neck will fare when the blood-dimmed tide is loose? Then the new Eurodollar Enterprises second skin neck brace is for you. Yes, strut through the wasteland knowing that marauding lynch mobs of war boys pose no danger. The carbon-fibre nanoweave is comfortable, flexible, and the ultimate luxury in an April dystopia you hastened. Barter aquacola for guzzoline at Thunderdome with no concern. The guillotine, is that the road warrior with a chainsaw? Then save your skin with your second skin neck brace. New from Eurodollar Enterprises.